Hello, everyone, and welcome back to day 64 of our 365-day life challenge. Today, we are diving into the world of equity investments in India. So, grab your notepads because we have got a lot to cover. Let's start with the basic. What is exactly equity investments? Well, simply put, it's buying shares or stocks of a company. An equity fund is a mutual fund scheme that invests predominantly into equity stocks, making you a part owner of that particular company. Now, let's talk about the types of equity investments you can make in India. There are primarily two types. The first one is the direct equity investments. This involves buying shares of individual companies directly from the stock exchange, from the stock market like BSE and NSE. Let's look at some of the examples in equity investments in India. First one is Reliance Industries Limited, RIL. One of India's largest corporate, RIL is a popular choice among equity investors due to its diversified businesses and stock market position. Second example I can take of HDFC Bank. It's known for its robust financial performance and stable growth. HDFC Bank is a favorite among investors who are seeking exposure in India's banking sector. The second major type of equity investment is investment in equity mutual funds. These are professionally managed funds that pool money from investors to invest in a diversified portfolio of stocks. I normally describe direct equity investment as your own vehicle you are taking from point A to point B, where you need to know the driving skill and you need to focus only on the road. It's like, nazar hatti, durghatna ghati type. Whereas mutual fund is like traveling in a public transport. You can relax, you can read a book, you can watch a movie, you can reach your destination. So your role is passive in this case as opposed to driving your own car where you have to be alert. Okay, so moving on, let's discuss the key features of equity investments in India. First one is the ownership in companies. When you invest into equity, you become a partial owner of the company. So the number of shares you hold determines your ownership stake. So returns through capital gains. So investors can make profit through capital appreciation when the value of the shares they own increases over the time. Selling shares at higher price than the purchase price results in the capital gains. Next one is the dividend income. Some companies distribute a portion of their profit to shareholders in the form of dividends. Investors in equity may receive dividends as a source of income. Next point is market risk. Equity investments are subject to market risk, and the value of stocks can fluctuate based on various factors such as economic conditions, market sentiments, and company performances. So next feature is liquidity. The stock listed on stock exchange provide liquidity. That means investors can buy or sell the shares very easily and they can get the money whenever they want. However, the liquidity of individual stocks can vary. Equity investments are traded on stock exchanges like the National Stock Exchange, NSE, or Bombay Stock Exchange, which is BSE in India. The next feature is diversification. Investing in a variety of stocks can help spread risk. Mutual funds and exchange traded funds, ETFs, are common investment. They are the common vehicles that offer diversification by holding a portfolio of stocks. Feature is tax implication. Capital gain tax is applicable on the profits made from selling equity investments. Dividend may also be subject to tax regulatory framework. The Securities and Exchange Board of India, SEBI, regulates the securities market in India, including equity investments. So investors need to comply with SEBI regulations and guidelines. But why should we consider investing in equity in India? So specifically, India is growing economy with a vibrant stock market. Equities have provided higher returns compared to any other asset classes like bonds or fixed deposits. Plus, investing in equities can help you beat inflation in the long run. While investing in stocks can be rewarding, it's crucial to understand the risk associated with that. So let's explore the the top 5 risks that investors should be aware of. The second risk is company specific risk. Each economy has its own set of challenges and opportunities. Poor financial performance, management issues, or industry specific challenges can significantly impact a company's stock value. Diversification across different sectors can help mitigate this risk. So, the third risk is the liquidity risk. So, while stocks generally offer liquidity on major exchanges, some smaller or less actively traded stocks may lack liquidity. This can affect an investor's ability to buy or sell shares at desired prices, potentially leading to increased transaction